Good evening, students. This is Om Prakash, Assistant Professor, Department of Business Administration CA, St. Joseph's College of Arts and Science, Autonomous, Cuddalore. In today's session, let us learn about the investment risk management strategies. Before stepping into the strategies, let us learn about a famous quote defined by Warren Buffett, one of the most successful investors ever. He is famous for spelling out the two most important rules of investing. Rule number 1, do not lose money, and rule number 2, never forget the rule 1. And it is also termed to be an investment defense. Ways to manage investment portfolio risk: follow your trend, rebalancing, position sizing, stop loss orders, and diversification. These 5 strategies are most predominantly used in all sectors and in all domains of investment. Follow the trend. The trend is to be investor's friend until it gets over or it ends. One way to manage investment risk is to commit to only buying stocks or exchange traded funds that are in uptrend and to sell them once they violate their trend line support. One can draw trend lines by connecting a series of higher lows on a chart, or one can use a moving average like the 20-day or 50-day or 200-day to act as a support. If the price breaks below the support level by a predetermined amount, the investor sells the stocks in order to reduce the risk involved in the position. Rebalancing. Longer-term investors may try to manage risk by periodically selling stocks or investments or asset classes that have come to take up too much of their portfolios. They will sell off those assets that have underperformed and buy more of the stocks or ETFs that are performing. This can be a forced means of buying low and selling high. Usually, the rebalancing is also termed as restructuring so that the overall portfolio dimension is kept at a lower possible risk exposure. The best possible rebalancing is to keep 10% of investment in one stock or a maximum 10% of investment in one stock and having more predominant positions in the portfolio. Position sizing. Another way to play defense is to limit the trading or investment exposure. If a given investment is riskier than others, the investor can choose not to invest in it or to invest only a small amount of the capital into the risky venture. Many investors use this type of approach to gain exposure to the riskier sectors like biotechnology or small cap stocks. A 50% loss on Rs 2000 investment hurts a lot less than that it would on a 20,000 investment. The easiest way to lower the stock market risk is to shift some of the capital to the cash. Very few examples state that position sizing mounted to very large sizes have the most higher degree of risk so that the total capital of the investor get lost in one adverse condition. Stop loss orders. These stop loss order strategy was used widely by the intraday traders and the scalpers. It helps to mitigate the risk if the position taken reverses. The idea is to lose less at the reversals In order to maximize the profits, the traders or the speculator uses trailing stop loss, in which the stop loss is adjusted automatically as long as the position remains in the favorable direction of the trader. Stop loss automatically sells out all or part of the position in a given stock or ETF if it falls below a preset price point. Placing a stop loss order is one way to limit the damage to the portfolio and force the trader to follow a strict defensive discipline. Moving or ignoring stop loss levels almost always results in greater loss in the end. Remember, the first exit is always the best exit. Diversification. Among all the strategies, diversification is one of the finest strategy to limit the risk, but it only works if the assets the investors buys are truly uncorrelated. The idea behind investment diversification is to buy asset classes or sectors that are not correlated. That means that if one goes up, the other is probably going down. Diversification usually involves creating a portfolio of investment instruments such as equities, bonds, securities, gold, mutual funds, fixed deposit schemes, etc. Common method of diversification, which involves choosing stocks from different sectors and allocating capital on each stock at a desired proportion. The capital allocation should not be more than 10% of the total capital in each stock. There should always be a free capital for the purpose of averaging the investments if there happens to be a downfall. Diversification has been a lot more difficult to achieve as many asset classes have become highly correlated. Even stocks and bonds have been moving in the same direction much more often than in the past. People following a mixed level of strategies shall apply all the 5 strategies in their portfolios so that they are able to mitigate their risk at a lowest possible level. Thank you.